So silver's not going to go to 200 fourfold. It's probably going to go much higher. Wouldn't shock me if you had $1,000 mark on silver at some point in the next year. Let's say silver made a mistake, supply-demand mistake. We know we have a deficit, but most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long. And I don't just mean the increasing demand industrial for silver, but I'm talking about the monetary crisis. Those headlines will suddenly come up to the fore, but silver will then be 150, 200, 250. And all people say, oh, now I understand. That's usually the way it occurs. It rarely is that all the real truth headlines come before the move occurs. It doesn't happen that way. It usually comes later, and I suspect that's when silver will look like a wet bar of soap. Whoa, China's buying gold, not silver. Okay, well, I think India is actually heavily involved in silver right now and even moving toward monetizing it. But for 3,000 years, silver's been money. Silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, etc., it likely will do it with speed.
I want to start by revisiting your call for $300 plus silver. Now, it looks like the metal could be staging a comeback since that significant correction we've seen after hitting new all-time highs earlier in the year. I'm wondering, at this point in time, what are you seeing ahead for silver for the remainder of 2026?
Oh, wow. I'm going to lift my target. And I don't mean lower it. I mean, probably lift it. And I'm not going to put a number on it. I'm just going to say that I think silver will go berserk. And the reasons are, there's multiple reasons. We can get into those. But yes, and the action last week turned up our intermediate trend metrics, momentum things. Now, what I mean by that is, when you look at long-term analysis of silver and gold bull trends, like annual momentum, so forth, the break was a nice break, but it didn't break anything. It didn't break any structures on momentum. So the long-term trend remains positive. That was a negative zigzag and a positive trend. So, but when we go down to more intermediate technical factors, things that come and go in a matter of a couple months or several months, they turn negative. They turned negative about in March, really, prior to that war break. Okay. But since then, if you stand back and look at a silver or gold chart, go back to that break that occurred in late January, early February. It was really about a 2-day break. People don't realize it was like 2 days. Bam. Silver hit a low of 63.90. Phew. And then went back up to like $90 and it came down and made another low at about 61.
Silver's biggest danger may be that investors mistake a correction for a broken bull market. Michael Oliver notes that intermediate momentum has turned higher, while the long-term structure never actually broke. Meaning, the recent weakness may have been absorption rather than distribution. The overlooked pattern is repeated lows holding, despite aggressive selling, suggesting buyers are defending specific levels. For investors, that distinction matters because missing the reversal could mean chasing silver after the repricing accelerates. Next, Michael Oliver exposes why the February collapse may have been the real signal.
Didn't fall apart and turned back up again. Teasing rally. Then came back down again, got to about 56. Okay. But right now we're trading 65. Okay. We're back above those lows, all the lows that occurred, the sequence of lows. But if you think about it, all those lows were like marginal teasers. The real low occurred 2 days after the high in February. And so since then you could draw a line sideways on silver and say, well, yeah, it's still under pressure, but it really isn't going down much since 6 months ago. Okay. So somebody's been buying that beast down there. Okay. Same with gold, same sort of pattern of a low in early February, then another low in March, and then you get the point. The upturn we just had last week on most people's charts say, well, it's just another rally in this nonsense range. You know, it's no good. It's just a sell the rally. Okay. But when you look at momentum, it says, no, this one's different. This is a rally that will likely sustain and work its way back to and through the highs. And I don't think it's going to take a long time. I think it may take like a month. Suddenly you're back up well off the lows and challenging highs. But forget that. The issue is, where are we going? And a lot of people make the mistake of taking out their old daily price charts or weekly charts from 1980, or that second high we made at $50 in silver in 2011. And they say, well, we just collapsed just like that 1980 peak, and it took them decades to get back up again. Okay.
6 months of sideways action can hide accumulation that only becomes obvious after the breakout. According to Michael Oliver, silver's repeated lows around $56 to $65 show resilience rather than collapse, while momentum now suggests this rally could challenge previous highs within months. The key contradiction is that bearish charts emphasize old 1980 patterns, while ignoring how quickly modern markets can reprice. For wealth preservation, waiting for confirmation may mean buying after institutions already reposition. Next, Michael Oliver unravels why the old silver crash comparison could be dangerously misleading.
Well, that's assuming. Don't look at the old arithmetic charts. Look at a ratio scale chart, a percent scale. We've run these charts before, but think about this just for a moment. You don't have to be a technician. Metals. Let's see what metals here I got. These are just examples: lead, steel, zinc, aluminum, copper, all base metals, and gold. Where are they trading right now versus where they made their highs back in 1980? About 4 times that price level. Okay, 4 times. Gold's more than 4 times where its bear low was in 2015, or where it was in 1980 when it made a peak at 850. Multiply that times 4 and you're above that level. Silver's what? Trading 10, 15 cents above its 1980 high. So let's say silver made a mistake. Supply-demand mistake. We know we have a deficit. It's been for 6 years or so where we're not producing enough silver to match the demand. And yet that's ignored. The fact that most metals on the planet are 4 times where they were in 1980. And yet silver is overdone, with a pullback recently to a 6 cents above its 1980 high. I mean, give me a break. Okay, so what caused that? Well, I don't have the answer. Some people I respect do, and they argue it's been actually manipulated by major banks, perhaps working in shoulder to shoulder with the central bank. I don't know. Forget that issue. But obviously silver, for some reason, has not moved in reality with every metal on the planet.
A fourfold move in other metals makes silver's valuation look less extreme than headlines suggest. What Michael Oliver is highlighting is the widening gap between silver and metals already repriced from 1980 levels. The overlooked issue is relative valuation. Silver does not need a fantasy narrative if it is correcting a long-standing distortion. That could make $200 less an endpoint than a midpoint. Next, Michael Oliver exposes the ratio that could redefine silver's upside.
And its mama metal in the monetary sector, gold. It moves with gold, right? Okay. Well, how come when silver back in 1980, for example, was what? 6.5% of the price of gold. Divide an ounce of silver and an ounce of gold. Where's silver right now? About 1.5%. What's going on here? We don't need silver anymore? It's not money anymore? No. Silver made a mistake. And therefore, to get back to the first issue about where we're going. Even if it went up fourfold, which would put it, $200 silver above the $50 high, that would be normal. But most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do 2 things. One, they compensate with speed, that sometimes is shocking, and 2, an overshoot of reality. Okay. And of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at fourfold. They'll probably be at sixfold, sevenfold versus 1980. So silver's not going to go to 200 fourfold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year. Okay? Because there's a lot of things going on out there. We can get into that.
Silver's biggest valuation clue may be its shrinking relationship with gold. According to Michael Oliver, silver fell from roughly 6.5% of gold's price in 1980 to around 1.5%, creating a massive relative gap. That means a return toward historical ratios could produce a far larger move than conventional forecasts assume. For investors, the danger is dismissing exponential repricing as impossible because it has not happened recently. Next, Michael Oliver reveals why overshooting fair value could be part of the correction.
Yeah, I've actually had Lynette Zhang point to potential for $1,000 at some point if the true value of silver was to actually be reflected in the price on our screens. There's a couple other people who've also pointed to that figure I've spoken to as well. So I don't think incredibly far-fetched. Would love you to dive a little bit deeper there into what you were alluding to, into other factors that you think could be driving the silver price higher outside of just the technical indicators and everything you've laid out for us there, because there's also a narrative going on in terms of those who are bearish that silver is actually no longer a monetary metal. We have now seen the Bank of International Settlements declare gold a tier 1 asset. Central banks are accumulating gold at a rapid pace. It's very largely kind of making a re-entry into the monetary system in some form or another, not transacted as money, but it's being taken very seriously as a monetary metal by institutions worldwide. Silver doesn't necessarily have that going for it. Is that kind of bearish view, is that legitimate in your view? And anything else you could shed light on in terms of the drivers for silver ahead?
No, I don't think it's legitimate. I think it's somebody looking for an excuse to why silver didn't go up like gold. Okay. And so they say, whoa, China's buying gold, not silver. Okay. Well, I think India is actually heavily involved in silver right now and even moving toward monetizing it maybe. But for 3,000 years, silver's been money.
The strongest bearish argument against silver may depend on pretending history suddenly stopped mattering. Michael Oliver's argument suggests silver's monetary role did not disappear simply because central banks currently favor gold. The overlooked point is that institutional preference for gold does not eliminate silver's industrial scarcity or monetary history. If investors wait for official recognition, they could enter only after the repricing becomes obvious. Next, Michael Oliver unravels why silver's non-monetary label may collapse under pressure.
Poor man's gold, okay? With official government stamps on it even, okay? So no, I don't think suddenly now because somebody wants to explain why silver didn't match gold, it's not money anymore. We suddenly decided. Well, we'll see, okay? I don't accept that argument. I think what's going to happen is silver's just simply made an error. A lot of markets do. And whether that was in part manipulation. But it's when it unleashes, it goes to a new reality. It likely will overshoot that reality even. But I'm looking at various metrics, not merely that if all these metals are 4 times their price in 1980, well, they're not stopping either. Copper's continued 6 times where it was in 1980 right now, okay? 1980 was $1, okay? So the point is that silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, etc., it likely will do it with speed. And I suspect that when that event occurs, and I think it's coming, I think when we come up out of this congestion, and already we have signals that we're coming up out of here. Okay, you can wait till the new high if you want to. But on the other side of this congestion zone will be something that will drop jaws. And be so rapid, so quick that people just won't understand it. But at that point in time, I'm going to bet that certain other fundamental factors come into play that already are in play, but have been long ignored by investors and analysts and talking heads on financial TV.
The real silver risk may be waiting for the breakout that proves everyone else was already wrong. This is where Michael Oliver's thesis shifts toward a pricing error that could unwind rapidly once momentum escapes its congestion zone. Copper's roughly six-fold move from 1980 provides a useful benchmark, suggesting silver's lag is increasingly unusual. For investors, confirmation can become expensive when repricing happens quickly. Next, Michael Oliver reveals which ignored fundamentals could turn momentum into a monetary shock.
Mainly monetary crisis, debt crisis, government debt crisis. We haven't had one of those in a long, long time. Okay. In 2008, the markets collapsed. Silver and gold went up, 2000 through 2011. But the stock market went down because of what? A debt crisis, but it was just mortgages. This time it's government bonds. This is a nuclear event. And it's only now marginally becoming sort of a sideline issue on financial press. It's so major it should be the front headline and should have been for a year now. The Japanese went into the hole, and now suddenly we're going into the hole with them. In fact, we're helping fund them try to get out of the hole. We're printing money to support the yen, so they'll continue to hold bonds, like a circle there, okay? It's a game. But it involves what? Printing money. That's what moves monetary metals. But that other side of that move in silver, when it occurs, I suspect you're going to start to hear the fundamentals that really matter. And I don't just mean the increasing demand industrial for silver, but I'm talking about the monetary crisis. And those headlines will suddenly come up to the fore, but silver will then be 150, 200, 250. And all of a sudden people say, oh, now I understand. Okay, that's usually the way it occurs. It rarely is that all the real truth headlines come before the move occurs. It doesn't happen that way. It usually comes later, and I suspect that's when silver will look like a wet bar of soap.
The bond market could become silver's biggest catalyst precisely because financial media treats sovereign debt as background noise. Michael Oliver notes that today's risk differs from 2008 because government bonds sit at the center of the problem. If monetary support expands to protect currencies and debt markets, precious metals can respond before the public understands why. For savers, that means waiting for the crisis headline may mean missing the protection trade. Next, Michael Oliver exposes why the headlines may arrive after silver moves.
Does something need to go disastrously wrong in the global economy and monetary system for us to get to four-digit silver? Or is there a way there without these sort of dislocations occurring?
We're already there. It's just that nobody acknowledges it.
Right.
Jamie Dimon does. He said months ago, we got a bond crisis. We're going to have to deal with it. Okay. In other words, you can't keep pushing this thing down the road every 10, 20 years. We'll take care of it again. It's been going on for like a century now. And finally, it's reached a point where the Japanese have suddenly, like the prime minister over there said a year ago, we're going to print. Okay. And I know our current president would like to do that as well. Whatever it takes to keep that stock market up. Okay. And the Fed has already begun because they've been supporting the yen artificially. And that has helped expand the money supply. So I think those headlines will come, but we already are in the crisis, really. What we're going to hear later is the wave effects of the crisis. For example, at MSA, we're not just watching things like AI and semiconductors. Although we did give a good call on the semiconductors at the top. We're not far off the top. We said, that's it. Okay. The real issue is this underlying multi-decade government debt crisis and the jeopardy of the fiat currencies, not just Japanese yen, but us, Europe.
Four-digit silver may not require a spectacular collapse because the monetary problem can deepen quietly first. Michael Oliver notes that debt accumulation and monetary expansion have been developing for decades, with Japan offering an early warning of what sustained intervention looks like. The hidden risk is policy becoming dependent on perpetual support rather than genuine stability. For savers, currency protection becomes more important when governments prioritize markets over purchasing power. Next, Michael Oliver exposes the fiat warning hiding beneath apparent financial stability.
we're all in the same soup, and it's just a matter of degree and when. Japanese first, us second, Europe's going to be next. But fiat currencies in a crisis like this will come into severe doubt. People will say, well, this has been kind of neat for the last multiple decades, about 100 years or so, but it ain't working. It's not backed by anything, and it's out of control, and all we keep doing is printing more of it. And, I probably said it on your show before that, when your granddad built a house, it was 4,500. When your dad built one, it was 45,000. Now a median home is 450,000. What does that reflect? Okay, degradation in the money unit. Okay, the stock market right now, S&P, for example, you go back to the year 2000, the dot-com high. Look at the multiple gain in the S&P, where it is now versus then, and then go back and look at an M2 chart and see where M2 money supply was in 2000 versus now. Oh, S&P has matched the decay in the money unit. That's all it's done. The S&P, I can't buy more loaves of bread now than I could back in 2000 with the S&P. Gold has massively beat that, stayed ahead of it. It's held its value. Silver's lagging, and that's where we get the slingshot.
If currency debasement is the denominator, rising asset prices can create a dangerous illusion of wealth. According to Michael Oliver, comparing money supply with the S&P and precious metals reveals how much apparent growth may simply reflect a weaker currency unit. Silver's lag versus gold then becomes significant because delayed monetary repricing can produce a powerful catch-up move. For investors, preserving purchasing power matters more than nominal gains,